again in line with what we had guided in Q1, that we'll see a sequential margin improvement from Q2 to Q4. Free cash flow generation continues to be robust, with our DSO remaining with a narrow band. Last quarter was significant for us in terms of large deal wins. We had won our highest order booking ever, helped by a $100 million plus ONG deal we signed. We own total of 7 deals greater than $10 million. Coming to the guidance, the deal pipeline is healthy, and we see sequential growth continue across all the segments like this quarter. We hope to cross the Q4 FY20 revenue mark in Q4 of FY21. We raised our FY21 revenue guidance. We now expect a USD revenue decline of around 6.5% in FY21 compared to FY20. The digital engineering opportunity is large in each of our segments, and we are leveraging new age and digital technologies, which are about 50% of our revenue, to gain competitive differentiation and market share. I'm also happy to share with you that Genome rated LTTS as a leader, not only in R&D, the conventional R&D, but newer areas like digital engineering, IoT, AI, and digital trade, which forms the backbone of new product development today. Before I close, let me touch upon the transition. We announced last quarter that from 1st April, Amit will step in as the CEO. I have been helping Amit transition into the CEO role, and he will provide the update on our vertical performance in addition to large deals pipeline we have. As I look back at the last 11 years, building this company has been my biggest passion, and I would like to thank all the employees of the company and the people who have worked with me for having shared the same passion. I also want to take this opportunity to thank the investor community during the last 5 years for your patience and understanding the engineering services business, and for supporting and encouraging LTTS in all the way. I have firm conviction that this is just the beginning of our journey, and the next set of leaders will take the company to greater heights. I will always be available to assist and guide the leadership team whenever required. Thank you once again, and I now hand over to Amit.
Sure. Thank you, Dr. Banda. I wish you all a very healthy and happy new year. I'll talk about the demand outlook and large deal pipeline at each of our 5 verticals. Starting with transportation, we had a sequential growth of 3.1% with all 3 sub-segments, aero, auto, and trucks and off-highway growing. Aero turned the corner in Q3, growing sequentially in line with what we had talked in Q2. Growth was led by the defense part. While the outlook in commercial auto is still challenged, we see consolidation and product software opportunities here. Within transportation, the auto segment had a bit of a soft quarter in Q3 on account of seasonality. The spending continues to rise in electric, autonomous, and connected vehicle space. We signed up with a few new age EV logos for some very interesting work involving both electric and autonomous vehicles. In TNOH, the opportunity continues to be in localization, value engineering, and electrification. For transport overall, we won 3 deals greater than $10 million in Q3, and we see multiple deals in the pipeline, consolidation opportunities in some cases, and new age in others in the autonomous and EV space. We see the momentum for transportation picking up as we head into Q1 of next fiscal. Moving on to plant engineering, we had a good quarter with 9.2% quarter-on-quarter growth, with the momentum strengthening versus the previous quarter. In FMCG and chemicals, we see traction in the areas of EPCM services relating to brownfield expansion, low-cost automation of plants, and discussions around sustainability. In the ONG segment, companies are looking to increase reliability and performance and want to leverage digital technologies to achieve the same. Talking about large deals, you are aware of the $100 million deal in Q3 we got from an oil and gas major. We see large deal potentials with others in oil and gas as well as chemical sector through the engineering value center model. The growth momentum will continue in plant engineering with opportunities in the pipeline as well as the ramp up of the 100 million deal which will start in the Feb-March timeframe. Now on to industrial products. This is another segment where the momentum improved from quarter 2 to quarter 3. We had growth of 5% plus quarter on quarter in quarter 3. Demand was driven by digital in creating smart products, value engineering of existing products, and productivity improvement initiatives on the shop floor. We are seeing and setting up specialized labs in creating solutions in the area of cybersecurity and test automation for our customers. The sustainability trend is driving more spend towards alternative energy sources like wind and solar, and we are leveraging our domain and technical strengths to assist with the technology framework and optimization in this area. We signed 3 large deals in IP in quarter 3, and we see additional deals in the pipeline in the digital space, which gives us confidence about growth continuing in industrial products. On to telecom and high tech, we saw growth recover in Q3 in line with what we had guided in quarter 2. The quarter 3 number also includes the Orchestra acquisition. So overall growth in telecom high tech was 14% quarter on quarter, of which organic growth was 3.7%. In semiconductor, we are seeing an improvement in the deal pipeline driven by spend towards new generation chips that leverage 5G and AI, giving us opportunities in design, chip verification, network interoperability, etc. In media, there is traction in design of software for applications and media devices, including technologies like RDK, Android, as well as consolidation opportunities in the legacy product maintenance area. In telecom, with the help of in network virtualization and 5G related activities. Coming to large deals, we won 1 large deal with a net new client in the telecom high tech area in Q3, and we are working on a few large deals in the 5G space in telecom and semicon. Overall, we see growth continuing and expect the momentum to increase pace by quarter 1 with the conversion of some of the large deals in the pipeline. Lastly, medical, we had a soft quarter of 2.4% quarter on quarter. There was some caution in spending as elective surgeries got pushed back yet again because of resurgence of COVID cases in the US. The outlook remains positive, however, with opportunities in digital product design, digital manufacturing, and regulatory compliance. New growth areas for us are in the areas of precision medicine, population health management, and telehealth. We won 2 large deals here in Q3. One was a 25 million plus vendor consolidation deal with a prominent OEM, which will help us expand our existing engagement to multiple geos. We see good deals in the pipeline and expect growth to bounce back in Q4 and beyond. To summarize, Q3 saw us sign TCV, which was double of the previous quarter, driven by the 100 million deal as well as others that we signed. We are seeing a continuous flow of deals with speed of decision making close to pre-COVID levels. We, however, are watchful about the lockdowns in Europe and Japan, and though we have not seen any impact so far, there could be a slowdown in decision making in the current quarter. That said, our deal pipeline has grown sequentially over the previous quarter. We expect this to help us continue the growth momentum. Before I close, on behalf of employees of LTTS, executive management, and I personally would like to thank Dr. Panda for his leadership and guidance. Some of us, like myself, having worked with him for more than 2 decades, others have worked about more than a decade with him, have always been inspired by his drive and motivation to take LTTS to the top. When we started this journey in 2009, IT was a known industry and engineering services was a possibility. Dr. Panda, under your leadership, LTTS has today emerged as the largest pure-play engineering services company based in India. We congratulate and thank you for your guidance, and we look forward to continuing the journey under your guidance. Thank you so much again. I now would like to hand over to Avi.
Thank you, Amit. Greetings and a very happy new year to everyone. It has been 3 full quarters since we have been managing business with the pandemic. Now I would like to provide an update on some of the initiatives and progress on the operations front. Firstly, let me talk about training and upskilling, which is an area where we have made very good progress. We had invested in setting up a global engineering academy 3 quarters back with a vision to provide deep technical training and certifications in line with our customer needs. We couldn't have thought of a better and more timely investment. As a result, we have been able to provide cross-skilling and upskilling to over 9,000 employees, which in turn helped us grow the business in the digital and leading edge technologies faster. Another area I want to highlight is a focus on design labs. We continue to invest in technology solutions for and with our clients. One such investment done helped us get enrolled as the only India-based service provider and one of the 6 globally authorized partners in the world to support Amazon Alexa voice service integration for connected devices spanning multiple domains and industries. Another example of investing along with our clients is the opening of a hub development center to provide our auto customer drive support in developing intelligent next generation solutions. As you know, we leverage our labs to win new business. We also have an in-house asset management portal where we keep building an inventory of reusable assets, which has seen good traction in the last few quarters. Many of our engineering labs have been enabled to be demoed virtually to our global customers without them having to physically visit our development centers. Now let me shift gears to discuss utilization. We have improved this metric over the past 2 quarters, going from 71% in Q1 to 75 in Q2 and then 77.5 in Q3, which has been one of the primary levers for the Ebit margin improvement. We are also keeping a close watch on attrition, which at 10.7% YTD is the lowest level in the past few years. Finally, on work from anywhere, or what we like to call WFX, our employees have been getting back to office since June 2020 in a gradual way. Today, around 66% or 2/3 of our employees in India are working from office at least once a week. Through our trademarked Omni-Office WFX methodology, we have trained and WFX certified more than 200 of our project and program managers in areas like productivity management, team morale management, customer trust enhancement, and security, which are essential in today's times. So, to summarize, we have tried to adapt to these challenging times and become operationally more resilient. We will share the progress with you as we move forward. I would like to hand it over to Rajiv now.
Thanks, Abhi. Good evening to all of you and wish you a very happy new year. Let me walk you through our Q3 FY21 financials, starting with the P&L. Our revenue for the quarter was 1,401 crores, growth of 6.6% on sequential basis. We had a second consecutive quarter of margin improvement, with EBIT margins rising by 150 basis points to 15.2%. The improvement was driven by a combination of higher utilization, improvement in offshore revenue mix, and better operational efficiency, partly offset by reinstatement of variable pay in full and higher subcontracting cost. While the margin improvement at the EBITDA level was 200 basis points, there was an additional 50 basis points impact at the EBIT level due to amortization on account of Orchestra Technologies acquisition starting from Q3. This explains EBIT margin improvement of 150 basis points on a sequential basis. Moving to below EBIT, the other income was lower on quarter-on-quarter basis, primarily due to lower export incentive scheme, partly offset by higher forex gains. Net income for the quarter stood at 186 crores, which is 13.3% of revenue, up 12% on quarter-on-quarter basis, driven by higher revenue and operating margin. Moving to balance sheet, let me highlight the key line items. Goodwill and intangible assets have increased due to OT acquisition. DSO was fairly steady at 73 days at the end of Q3 compared to 72 days in Q2. The unbilled days reduced from 20 days to 17 days sequentially. So combined DSO including unbilled stood at 90 days, well within our target range of less than 95 days. Improvement in DSO has resulted in cash and investment rising to 1,450 crores plus. And this is after the payout of FY21 interim dividend and the payout for acquisition of Orchestra. Let me now talk about cash flows. The year-to-date free cash flow stands at 962 crores, which is roughly double our year-to-date net income. This performance was largely driven by a sharp reduction in DSO in the first half of the year, that is over Q1 and Q2, we aim to maintain combined DSO within our target range of less than 95 days. So to that extent, the free cash flow conversion on a sustainable basis will moderate from what you see currently. Moving to revenue metrics, the dollar revenue grew 6.8% in Q3, and if you look at the performance by segment, we had a broad-based performance as Dr. Panda and Amit highlighted. Growth was led by industrial products, telecom and high-tech, and plant engineering. The segmental margin performance also saw improvement across the board. All segments improved margin by 100 basis points plus, except for telecom and high-tech, which would be equally strong but for the impact from earn-out provisions due to Orchestra acquisition. Moving on to operational metrics, utilization has seen an improvement of 210 basis points on a sequential basis, while on-site offshore mix improved in favor of offshore by around 200 basis points sequentially. Fixed price and T&M mix remained broadly within the range of 40-60. Client profile, which is number of million plus accounts across categories, showed a sequential improvement in the $1 million plus range, while others are either marginally down or flat. I'd like to highlight that this metric is on a last 12-month basis and not on a quarterly analyzed basis. So to that extent, it will take longer to reflect the quarterly improvement we are seeing in every category. As LTM includes the Q1FY21 revenue, which had a sharp dip. In terms of client contribution to revenue, here again, this is on LTM basis, and it appears that top accounts have declined sequentially. However, we have seen growth across top 5, top 10, and top 20 on a sequential basis, which is in line with the overall company growth of 6.8%. Headcount increased by 167 people sequentially, while attrition remains flat at 10.7%. Our realized rupee for Q3 was at 73.7, largely flat on a sequential basis. Before I end, let me give some color on the Ebit margin trajectory we are seeing going forward. Similar to what I had indicated in Q2, on the positive side, we will continue to improve utilization and achieve better operational efficiency across productivity and attrition. We see scope to increase margins in segments like telecom high-tech while continuing to push for better growth in high margin segments like medical, industrial products, and plant engineering. On the adverse side, we have headwinds from rupee appreciation, wage hikes, on-site localization, and other expenses that are linked to growth. For example, usage of third-party contractors, subcontracting, etc. Overall, we aspire to take Ebit margins to the earlier range of 17% on constant currency basis and continue to work sequentially to improve margins. With that, now I hand it over to the moderator for any questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Also, before we begin, we'd like to inform participants to please limit your questions to 2 per participant. Should you have follow-up questions, we request you to rejoin the queue. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vibhor Singhal from Phillip Capital. Please go ahead.
Thank you, sir. Thanks for taking my question, and congrats for a great set of numbers. So my question was primarily on the outlook that we see, of course, started explaining in terms of different verticals. So generally, we have seen that post any financial crisis or because of any kind of external event because of which corporates are basically forced to cut down their spends, we see the R&D spend come with a lag, maybe with 1 or 2 quarters, and this is specifically across segments is what we have historically seen. So do you see that kind of a trend this time as well, and that we are basically in the mode of vaccine being rolled out across the globe? So those spends are slowly coming back, and not just the keeping the lights on kind of spend, but also incremental spends which could lead to strong growth momentum for us in FY22 and beyond.
Amit, can you take that question, please?
Sure. Sure, sir. So if the question is, and you were cutting in and out before, so if your question, I'll repeat it, is that do we expect growth in spends? Is there a lag or is it coming back to pre-COVID levels, correct?
Yeah. So specifically speaking, sir, basically, if there is historically, is this understanding correct that R&D spends recover with a lag? And if it is, then is that lag behind us, or do we expect maybe it to recover maybe in the coming quarters?
So number one is that we definitely are seeing R&D spend back as we stand today. That is number one. Number two is that the spend that we are seeing coming back is in two areas. One is digital engineering, and the second one is legacy engineering. And in both these areas, we're seeing consistency in spend coming back across all the verticals, except commercial aerospace, that we believe will take a little bit more time. We are focusing for commercial aerospace. We are turning around and we are focusing on the defense area in the US. But outside of that, all other sectors, as we see today, have that spends that they used to have. Are they exactly at where they were? Are they higher, slightly lower? But broad-based, we are seeing them back at where they used to be. We do believe that will provide us a tailwind as we move forward towards growth.
Sure, sir. So just my second question, if I could squeeze in, is on the plant engineering division. I think we've done phenomenally well in that segment, and that continues to be our strength. Up till now, I think we've seen on the base of the deals also, it's being driven by the oil and gas segment and the likes of it. In terms of retail and CPG segment, how far do you believe we are from a full-fledged recovery, and we could see some, let's say, greenfield expansions or some those kind of spends coming back in this segment for us?
So from a plant engineering,
the attempt, and I will ask Amit to answer this. See, it's like our growth is in oil and, overall plant engineering, not just oil and gas. We are growing in FMCG segment as well. So FMCG segment has done reasonably well. Some of the learning we had in FMCG segment, we have taken to oil and gas. The last deals we own, that is because of that. So these two, we always draw a line between what is common between all the segments, the specialty chemical, oil and gas, or FMCG, and those common service offering we take one to other. So that has given us the earlier. If you see 1-2 years ago, our dependency more on the greenfield project and brownfield project. And if there is a ground, that's something we don't control. But what we control is we understand the plant very well. We understand what technology required for the plant very well. So then how do we take that for the customers, the efficiency improvement, then we take over complete plant as a whole. I think that model is working well. More and more is going to be in that area, I would think, moving forward.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to understand, as the decision making has come back to pre-COVID levels, you guys believe that the FY22 or CY21 could be a year of pent-up demand, or you believe it is too early to expect the same? And a related question is just on the fourth quarter. If I look at your implied guidance, it comes to around 3.2% Q1Q, of which, if I'm not wrong, 1.5 to 1.8% growth may be driven through $100 million deal and 0.4% maybe through cross currency. So the rest of the business outside the $100 million deal and a cross currency tailwind would be just 1 to 1.5%. So is it a conservative, because your deal wins are robust even outside the $100 million deal? And then I have a last question on margins after this.
On the deal side, and Abid, you please discuss about the customers buying and what's going on. And Rajiv will answer the margin part of it. He will talk about, Q3 to Q4, how we look at it overall. Can you do that?
Sure. So Sandeep, as far as decision making is concerned, as far as that is concerned, we are seeing decision making happening at a faster pace than it was in Q3 and Q2, right? So that is point number one. Point number two, is there pent-up demand that, we'll all of a sudden see a big rush coming in? The answer is that things have been gradually coming back quarter on quarter, and that shows up in our results as well, right? Also in our deal closures, etc. So as we go forward, we continue to be optimistic about the future in terms of growth, right? So that is point number one. Point number two is the 100 million deal that we talked about. I also mentioned that the ramp up will start in a gradual manner. At the end of February, early March is when it will start. So the full, and it will take time for it to ramp up completely. So the guidance that Dr. Panda has provided right now and we have provided is where we are comfortable in steering you right now. Of course, we will try and we will make all efforts to make sure that we bounce back faster, stronger, better, etc. That is two. Third is that so that's regarding the deal in quarter four. Ebit, I will request Rajiv to cover.
Yeah, Rajiv, just on the
one more point I want to say. Look at this way, that the 100 million deal has not contributed revenue till now. This is, we are taking over from a Western company. They have been doing for last 20 years. Now there is a knowledge transfer. There are a lot of things, process, understanding, doing that. It takes time. One thing for sure, this deal is going to contribute in a big way next year. Whereas actual revenue, how much we are going to do in February and part of March, how much we do part of February and March, I think that we are still working on it. So that is one of the reasons we want to make sure that we give a guidance where we know for sure. We don't have the luxury of not meeting what we talk to you. So we are very careful about that, and based on that, what I see today, we have given a guidance.
Yeah, fair enough.
Rajiv, you want to add? Rajiv?
Dr. Panda, I'll just let them pose the question on margin and then I will add to it.
Yeah,
okay,
so Rajiv,
okay, that's fine. Thank you. That's fine.
So Rajiv, my question on margin is the implied guidance indicates that our revenue run rate would be similar in the Q4 versus the pre-COVID level, and in the earlier quarters we have said whenever we go to that kind of a run rate, our margin can improve to the pre-COVID level, which is close to 16.5 to 17%. So is it fair to say that by fourth quarter itself we can aspire to be there, or it may take slightly longer time? And when are we planning for a wage inflation? Because it looks like if it's not coming in fourth quarter, we are not giving any wage hikes in FY21. So do you believe this may be a risk to the attrition, because across industry there could be a 2 round of wage inflation in a span of 2 or 3 quarters?
Sure. So I think you've got 3 questions. Let me respond to each one of them. So as far as, we've always maintained over the last 2 quarters that we will exit Q4 FY21 at Q4 FY20 levels, right? And you sort of computed and the implied guidance for Q4. To be specific, I think as far as, the revenue, we see the trajectory to come back to Q4 FY20 levels. And at the back of it, right, I think what we endeavor to do is also to have profitability come to levels of Q4 FY20. And that's how we see it. The second part is, in terms of the wage increases, we will see wage increases effective April 1 for junior grades, and for senior grades, we will see that effective July 1. As far as attrition, we've been around the 10.5, 10.8% range. We believe that Q4 there may be a slight uptick on attrition. I think the attrition has been rather tepid over the last couple of quarters, but we see that going up slightly. But it's not concerning at this point in time that I would call out. Hope that responds to your question.
Yeah. Thanks. And all the best, Dr. Panda. It's always informative to talk to you. Yeah.
Thank you.
Thank you. The next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just wanted to understand the large deal win which you have signed with the oil and gas major. Any color in terms of how the commercial construct of this deal is different from previously signed deals or the other large deals that you typically have won? because this is significantly larger in size. So maybe in terms of any kind of a pass-through to this, or is this pure play services? Any color that you can give here that would be useful.
Pankaj, it's like this. The deal what we got now, this is, again, I did explain last time about sustainability engineering and digital use of new technology for the performance improvement and so on. So the difference, earlier what we did, only thing, clear difference in earlier what we did and now what we did. Earlier was upstream, this is downstream. Okay? Because a lot of investment in upstream is not happening when oil price has gone down, or limited the investment is happening there. So we realized we are not going to wait for oil price to come back to 60. Of course, it's come to, it is increased now to 52, 53 now. So we said when this oil price is low now, what are the options available to us and what technology offering we have, we can go to different areas. So this is the downstream work we are doing it for the refinery, and that's where I think much more opportunity. And imagine this is the two biggest plant is what we have taken over and which we are providing services. And I strongly believe this is a great opportunity for the segment as a whole. If we do it well, and there is no question of if, I'm sure we'll do it well, this can be taken to multiple refineries for the same customer itself. So this is a different type of deal, and we need to we are creating a center very close to the plant, and then we have a center, major part of the employees are going to work from India. So both combining both together, and they have made, this is the first time the customer decided to do this because of the cost pressure, and we have done good job. Same customer, we have been working for a long time, they know us well. So decided to switch to a supplier who is doing for last 20 years. They switched to LTTS. So I think there is a lot more things we learned in the process of doing it, and I believe this is a great opportunity for engineering services company like us.
I understand that, Dr. Panda. This is really useful. My question actually was more around the any kind of investment that you need to make. Like you mentioned, you will be putting in some people for the transition, etc. So my question was more around that how could be or how much would be the margin impact of this deal? That was the one which I was looking for. And related to that,
doesn't have margin dilution. We don't have huge investment. There is no major investment there, and there is no dilution in the margin purpose.
Understood. And Rajiv, my second question was on this quarter margin profile. You had several good levers playing out, like utilization, offshore mix, etc. And SG&A lever also played well. I was curious to know what were the headwinds here, because the margin expansion could have been far higher given the kind of movement in these levers. So what were the drags on the margins? If you can highlight and if you can give some quantitative color on that will be useful. Thank you.
Sure, Pankaj. I think you already highlighted as far as the tailwinds, right? I mean, we saw utilization improve, we saw offshore revenue mix improve. In terms of the headwinds, as we've mentioned in the previous quarter commentaries, this quarter, as we're now moving towards pre-COVID levels, we did provide for variable pay in this quarter, so that was the headwind. The other is, we did see increase in subcontracting costs as we service, increase in revenue. Those were the clear two impacts. And the third is, we had to take earn-out provisions for Orchestra Technologies. While that's, not significant, but those are the three headwinds to talk about.
Thank you. The next question is from the line of Vimal Gohil from Union Asset Management. Please go ahead.
Yeah, thank you for the opportunity. Sir, my first question is on digital engineering. Now, you cited Zinnov, and one of the reports they have released mentions that digital engineering is expected to grow at almost 20-25% over the next maybe 3 or 4 years. I just want to know how LTTS is planning to capture this trend, and what is the proportion of work that we do in digital engineering as a percentage of our total revenues, if that data is possible. Secondly, you spoke about one of the margin headwinds that you spoke about was on-site localization. Given the current situation we are in, and I mean in this pandemic, probably one thing is proven that things are moving as smoothly virtually as well. I mean, you're winning $100 million deals effectively virtually right now. So I just wanted to know what is the rationale behind going back to further aggressively increasing on-site localization, because that is going to put pressure on margins. These are my two questions. Thank you.
Yeah, I think I would the other part I would ask Ebit to answer. But one thing I'll tell you, the Genome report saying that 20-25% increase in R&D. If you see 2019 to 2025, the digital engineering or the new tech engineering CAGR of 20% growth. Whereas if you see legacy engineering R&D spend, its growth is only 2%. That means if you see 2030 or so, the legacy engineering is going to almost die down. Anything you do in the new tech engineering or it's called digital engineering. So we have 49% of our business comes from digital engineering right now. So we are moving much faster than what the industry is going, and we'll continue to maintain that moving forward. Amit, do you want to add and take this, please?
Sure, sir. So when we talk about digital engineering, we divide that up into multiple parts. Digital engineering for us is product design, cloudification, analytics, creating cybersecurity modules on products, as well as remote design collaboration, right? So these are elements as far as product is concerned, including looking at the total experience of the product from customer to user to employee, putting it together, as well as looking at the AI, ML part of it, etc. So that is one part, the digital product for us. Then the second part for us, so digital is digital manufacturing, which is on the shop floor, which is smart manufacturing. And some people call it Industry 4.0, other people have got different names for it, IIoT, etc. So we have been spending energy, time, and like Dr. Panda said, we've been investing in this area by creating labs, second, reusable assets, third, filing patents for ourselves and our customers, fourth, setting up a training academy that Abhi alluded to in terms of training our people. So all these four have been going on in parallel, and the Genome rating is just a vindication of what we've been able to do. Our wins that we have had and the industrial products growth that we have seen is also backed by the work we have done in digital, in discrete manufacturing in that area. In addition to that, 5G rollout as well as OTT for high tech will continue to be areas for us in digital that will grow. So those are the various components and sub-components, Vinay, if I look at the digital piece for ourselves. Rajiv, you want to take the localization part?
So the only part that I will add for localization, see, this is also a measure that we're taking to mitigate any H1B related challenges. So this is a thought through step. I mean, and also, we will try to see this over a period. So that's what I will add to as far as that question is concerned.
Thank you. The next question is from the line of Salil Desai from Marcellus Investment. Please go ahead.
I'm sure, sir, I'm not sure if this has been discussed in the earlier calls. But Dr. Panda, after 1st of April, do you have any role in any sort in the company? Would you be mentoring these?
I'm sorry, I don't know, the line is not very clear. Are you saying after March 31st, am I going to be around in the company?
Yeah, I mean, what role would you have, if any?
No, I'm not going to be in LTTS. As you know, we announced in the market that I'm going to be non-executive director for LTTS, right? And that we have already announced in our stock exchange filing last quarter when we did that. And this is very close to, I'm very passionate about this company, it's very close to my heart. And, a team of people, we all work together to build what we did. But be rest assured that, nothing we are going to leave it to any loose end, making sure that whatever the foundation we created, 538 patents and the customers. And if you see, one more, I will request all of you to have a look at it. Genome came with a report, Digital Engineering Services Rating for 2020. All the companies around the world, they have taken. And then in that, they have taken AI, digital trade, OTT, IoT. You see the positioning what we have in LTTS. This company, 2014, we created an independent company as Allied Technology Services. Today, in a very short time, anything on the new technology, our positioning has been, I think we are always in the leadership zone. And we'll do everything possible. I will do everything possible to make sure these companies continue to fly high.
Fair enough. Thank you so much.
Thank you. The next question is from the line of Pritesh Vora from Mission Holding. Please go ahead.
Hello, sir. Congratulations on good sets of number and quarter-on-quarter bounce. My question is, our background feedback we have got is, we understand that a lot of OEM have come to realize that a lot of cost saving can be done and synergy can be attained because the work anyway is done by outsourcing personnel sitting at home or their own personnel working from home. So that dividing line between employer and outsourced employee as well as the outsourced employee is falling very fast, which will improve the growth over the sector over the years. How are you reading this development?
Listen, I think our customers are all, we don't do very little work in India, right? Customers are outside. And the cost factor and some of the lab investment, multi-vertical knowledge what we have, it is very difficult for a customer to do. A German customer or a French customer not going to send people somewhere and use all their employees to work in a place, their local employees who are there today, and get the productivity and innovation what we have been doing it. It is, working from home is helping in one way to ask companies like us what they believed earlier cannot be done from home or offshore. They're believing that it can be done from offshore. That's a very positive move. And if you see we believe that, the revenue ratio offshore to on-site, that should work to our advantages. That's what we want. Whereas customers working from home, we work from home is saying it's not something good. This, I think if you extrapolate to IT, that conclusion we get here. In engineering, we have a power electronics lab, and we have, the different labs we have. Stay-down lab we have lab on the EV lab we have. So these labs, when you create it goes a lot of passion goes into this to create that. It is not something just put people at home or here or any country can be done. There's not a lot of multiplication, a lot of complications there. So I don't think we are worried at all in this. If at all, I think it's going to help us more than what we did in the past. That's how I look at it.
Thank you. The next question is from the line of Prashant Upuluri from Foyston Gordon and Payne Incorporated. Please go ahead.
Yes, good evening. My question is a little bit more from a longer term perspective on margins. And what is it about your transport and high-tech verticals that makes the margins appear to be structurally lower than the other verticals? Is it because of lower billing rates in these verticals or the mix of work? And what are the trends you see on both these counts? And kind of a related question is, who do you compete with within these sub-verticals?
I would like Abhishek to answer that on the margin front, transportation, telecom. Let him make an attempt to do that. And on the whom do you compete part, Amit will answer or I would answer later. Abhishek, can you take this question, please?
Yes, Dr. Manda. I think the question you asked on was, first let me talk about the transportation vertical. Transportation vertical, the fact is that as the pandemic broke, clearly more automotive T&OH customers asked for discounts than probably any other sector. And that clearly showed in the drop that we saw in transportation segment in Q1 and Q2. But as you can see, we are picking up there definitely. We believe that by Q4 we will come closer, actually probably cross the numbers. That's one. The second one, I think, on the transportation sector is, all of you know, aerospace business took a big hit in terms of the pipeline, and Amit already mentioned that. I think that is something that has hit us very hard. Despite that, like I'm already saying, by Q4 we'll pull it back to the overall transportation segment will pull it back to the levels that was in Q4. So I don't think there is a structural issue with the transportation segment. Of course, there are more captives. Most of the OEMs, tier ones and automotives have captives. that creates some competitive pressure. From a competition perspective in transportation, while for some of the we look at definitely Tata Elxsi, TCS, HCL, KPIT, some of the competition in India. And of course, we look at companies like IIV and others in the global companies as well. Very closely watch them, especially in areas like electric powertrain, where we believe that we have a very strong differentiated offering. Coming to telecom and high tech, I think there is work to do there. We have, the numbers are in front of us. We are not where we would like to be. Having said that, this specific quarter, despite the Orchestra Technologies acquisition, we were still on the positive territory. I strongly believe that we will keep moving forward in the high-tech segment as well from a margin perspective with every passing quarter over the next couple of quarters. I don't see any challenge there, given the kind of pipeline we have and the kind of, with OT coming in and the initial...
Let me help. Thank you, Abhishek. See, I think if you see outsourcing dollars happening, more happens in transportation segment and telecom high-tech segment. The truth is, this is segment, transportation is three components: off-highway, automotive, and aerospace. And this is a crowded. If you work on the mechanical side, it's highly crowded. Any company you look at it, they are into transportation, doing piece of business in mechanical engineering or some subsystem design, system design. Whereas, if you what we have done it now, this is a tough field though. Unless you attend to every minute, unless you have a clear differentiator. And this is going to be a difficult game to play with. We have made an investment for some time. This is a segment we entered late because other industrial, medical, plant, all that came from L&T legacy. A lot of experience we got from there. In this segment, they are now our focus on more on the electric vehicle. So we have taken what we learned from industrial to automotive. Now we are taking that to aerospace. This is a positive thing. We believe that's going to grow. Connectivity and IoT. This is again a big area now. That's going to help. We have telematics and connectivity. That's the area we are focusing on. Then in in the aerospace segment, the commercial aerospace will take some time. Commercial that to come back. Whereas we are looking at on the military side, on defense side, ITAR side. So we have few wins we had with a sizable decent margin point of view. So I think we improved from Q2 to Q3. If you see, 100 basis points we improved, and our goal is to continue to do only profitable growth, profitable business, so we continue to grow, and which we cannot afford to, because this is a growth engine, it's going to grow. On telecom high-tech, again, the component are, if you divide into, we have telecom infra, we have semiconductors, so there one segment is profitable, both segments are equally profitable, I would say, but we had OT transfer, which Rajiv talked about it. And one type deal we have taken for the knowledge, understanding that technology, which is going to help us on the media entertainment side. For example, we believe we are going to build competency which is going to have long run. So it is a margin not at the level of what we would have got. So it's a transactional one-time deal, low margin deal which has impacted there. But our goal is sequentially, quarter on quarter, we start growing margin in both the cases.
Thank you. That's a very helpful response. If I can just follow up a little bit on that, do you see a greater competitive intensity and RFP type deals in these two verticals? And I'm looking at margins pre-COVID. I'm less concerned about the past couple of quarters, but from a more longer-term perspective, if I go back even say 2-3 years, what is it about these two verticals that keeps their margins on a comparative basis lower than what you see in plant engineering or in industrial products?
See, I think on the transportation, Amit, why don't you answer this? Both transport and telecom. Sure. Please do that.
Sure.
Yeah, go ahead.
So on transportation, if you look at it structurally, right, and if we look at the kind of work that we do and the type of work that we do, there is a little bit of onshore work that, like, including the defense part that we do, that's being done in the US, right, and done out of our local delivery centers here. The new wins that we are having in automotive, that's in the areas of EV as well as autonomous, and electrification in TNOH, and in-flight entertainment in aero and software area and aero, is all improving the offshoreability of the work that's happening. So structurally, earlier, if you go back, like you said, 2 years, 3 years, there was a higher percentage of work being done onshore in transportation that slowly is moving offshore. And as we move forward, you will see that there is headroom for us to grow and we will improve the margins. Right? So that's number one. Number two is, and I'll also say one more thing on transportation, and Dr. Panda alluded to it. See, our differentiated offering in auto, in TNOH and aero, the new offering that we have got, is all around software, right? And a lot of that is where we are differentiated because we're bringing it from IT, we're bringing it from telecom. So we're differentiated from traditional players, and therefore we'll see improvement in terms of growth as well as margins in this area. But structurally, on-site is more, and that's slowly going down. Now let's go to telecom. Telecom, like was mentioned before me, has been in a very competitive marketplace, and therefore, if you look at it, we have had a challenge in terms of margins there, not just because of being competitive, but also because we had a division that is working out of, again, a non-India location servicing the telecom high-tech market. That particular center also now has been drawn down and the work has been moved offshore. There was a one-off transaction that we did to build technology in the areas of OTT in April of last year, April 20, and that again is now, by the time as we move forward, that particular thing will also get smoothened out, and therefore you are seeing there will be headroom for us to be able to improve our margins. So that's where we are.
Thank you. The next question is from the line of Kunal S. from Bank of America. Please go ahead.
Thank you. Amit, I wanted to follow up on, I think, a statement you made in your opening comments that you might need to watch the pace of decision making this quarter or in Q4. So just to better understand that comment, I mean, is it specific to lockdowns, a new wave of lockdowns that are coming, or is it because of general business uncertainty? And, if it's because of lockdowns, would you still think that the risk this time around uncertainty could be lesser than, what customers were foreseeing during the first wave? And maybe the final card, did you mean that this for Europe or US as well? Thanks.
Sure. So Kunal, thank you so much for that. Now, one, we are watching the lockdowns in Europe, and I will quantify Germany, UK, Sweden, these countries that have announced lockdowns till early Feb, right? So that's what they've done publicly, and even Japan has announced a lockdown till end of January, early February. So we are watchful of those lockdowns and whether they'll get extended, and therefore the impact of that on decision making in terms of speed of decision making is what we have said we are watchful about. We do not think that, to your second question, we do not think at this stage that we will come to March, April levels of 2020. But we are watchful at this stage. I mean, it's not that we are concerned, but we are watchful at this stage. And at this stage, we have baked that into whatever we have committed in terms of where we will end up.
Got that. And maybe just a quick follow-up on the variable pay part of it. Broadly, with the upper division this quarter, are you in the ballpark that you expect to be going ahead as well, or is there room for catch-up even from here?
Let me answer that. This is Rajiv here. So yes, we'll be in the ballpark to what has been in Q3. Hope that answers your question.
It does, Rajiv. Thank you.
Thank you very much. We'll take that as the last question. I would now like to hand the conference back to Mr. Pinku Pappan for closing comments.
Thank you all for joining us on the call today. We hope we were able to answer most of your questions. If you have any follow-up queries, please reach out to me on email. Wishing you again a very happy and prosperous 2021 and safe times. Goodbye and have a great day.
Thank you very much. On behalf of L&T Technology Services Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.
Thank you all.